If you feel like the investing rulebook you learned over the last decade has just been, I don't know, set on fire,
Hmm.
you are not crazy.
No, not at all. You're absolutely right.
That feeling is real.
It is. That feeling of dislocation is completely valid. For, what, 15 years, the financial markets operated under this very specific set of rules, a kind of easy mode.
Right.
But that game is over.
Yeah.
And just recognizing that structural change is the crucial first step for any investor today.
And we're talking about the period roughly between 2009 and 2021.
Hmm.
Zero interest rates, basically no inflation, and things were, well, relatively steady. That financial gravity where money was essentially free, it's gone.
Completely gone. And it has been replaced by this chaotic new era. It's defined by three immense, I'd say, permanent forces.
The accelerating AI revolution, structurally higher interest rates, and what geopolitical analysts have started calling the permacrisis.
And our mission in this deep dive is to synthesize the latest analyses and data to show you how to navigate this new reality. We need a strategy to rebuild your portfolio, not just to survive the volatility, but to, proactively profit from the chaos.
Welcome to everything you need to know about finance. We're dedicating this deep dive to understanding this major paradigm shift in asset allocation.
And we should be crystal clear. We're expert guides to the information, but what we discuss is based on analysis of current trends, data, and models.
Yeah, this is not financial advice.
Please, we encourage critical thinking, but always consult a professional for your personal circumstances.
For sure. And if you find this kind of content interesting, insightful, and helpful for gaining knowledge quickly, please like and subscribe. It is the best way to support what we do here.
Okay, let's jump in.
Let's do it. Starting with the foundation that really underpins everything, the end of free money.
Okay, so let's unpack this core realization. The free money era is definitively over. I mean, for an entire generation of investors, the default assumption was if the economy slows down,
The Fed rushes in.
the Fed rushes in and cuts rates back to zero. That expectation shaped everything, from housing prices to startup valuations, everything.
And the market narrative for years was cash is trash. You had to pile into risky assets, like unprofitable tech starts, just to earn any kind of meaningful return.
Because the safe alternatives offered you nothing.
Zero.
That narrative died when inflation proved to be persistent and, global stability fractured. The crucial piece of data driving this change is the upward shift in the neutral rate, or as economists call it, rise star.
Okay, so rise star. Break that down for us conversationally. If it's rising, what does that practically mean for, my long-term investments?
Great question. So, for years, the consensus was that rise star was around, say, 2%. Now, leading economists and central bank projections are signaling a new settling point that's structurally higher likely, somewhere between 3.5 and 4.5%.
So it's basically doubled.
It's a huge shift, and it means the Fed has much less incentive to cut rates deeply in a normal economic cycle. It means baseline borrowing costs are just permanently higher.
A 2% difference might sound small on paper, but that means the cost of carrying corporate debt just doubled or more. How does that translate into which companies win and which ones fail?
It creates a massive Darwinian shift in the stock market. In the 0% world, success was defined by selling potential.
The dream.
The dream, how fast you could grow regardless of profit. Companies could rack up billions in losses, funding operations with cheap debt.
I remember reading about startups getting mega funding with business models that were like 5 years away from making a single dollar.
Exactly. But in a 5% world, capital isn't desperate anymore. It has leverage. The cost of debt kills those dream-selling ventures much, much faster. The sources are unanimous. The new winners are companies defined by actual, immediate cash flow.
So profitability is king again.
Profitability, efficient operations, high margins. Money has moved from the speculators to the auditors.
But the critical actionable takeaway here isn't just about stocks, right? It's about how you manage your cash and your safety.
Absolutely. We need to talk about what some are calling a historical gift. For the first time in 15 years, safe assets are paying reliable, substantial returns. If you can lock in 4 to 5% on short-term U.S. Treasuries,
That's a real return.
that's a real return, and you've created a reliable financial anchor.
That anchor is so crucial because it changes the whole volatility equation. Why would you expose your capital to the wild swings of a growth stock to potentially earn, 7%?
When you can get 5% guaranteed by the government, you wouldn't. or at least you'd think twice. This safety net provides optionality that just wasn't available for a decade. It forces a fundamental reevaluation of risk. That 4 to 5% yield is a foundational layer. It preserves your capital, it hedges against downturns, and allows you to be much more selective and patient with your growth investments.
That makes perfect sense. The return of cost forces discipline across the board. Now let's use that concept of cost to transition to our second major force, artificial intelligence. We've all heard about the initial NVIDIA trade investing in the obvious chip producers, but that was phase one. That was the software hype phase. The real structural long-term opportunity, the one we need to deep dive into, is phase two.
The physical reality.
The physical reality of AI infrastructure.
Yeah, it's the infrastructure bottleneck. Most people think of AI as this, ethereal code running on a remote cloud server.
Right. It's just magic in the cloud.
But that server requires staggering amounts of physical inputs,
Yeah.
electricity, water for cooling, specialized materials.
And the demand shock is genuinely astonishing. We are seeing data showing that AI training and deployment are consuming energy at a rate the current grid just cannot handle.
The numbers are wild. Data center power demand is projected to increase by a colossal 160% globally by 2030.
160%.
According to some of these analyses. And to put that in perspective, a complex query, a simple chat-GPT interaction, can use up to 10 times the electricity of a standard Google search.
Wow.
Now imagine if AI becomes pervasive, embedded in every piece of software we use. We are talking about multiplying global energy consumption in an incredibly short period of time.
So we have a massive immediate infrastructure deficit, and this is where we apply that classic analogy, right? During the gold rush,
The people who consistently made money weren't the miners.
they were the ones selling the shovels, the durable jeans, the food, the underlying necessities.
So who is selling the electricity shovels to the AI miners today? It's not the software giants. It's the companies that manage, generate, and distribute power.
And the ones that supply the materials to build the physical network. This requires a highly contrarian investment focus. We need to look far beyond the glamorous software valuations and the chip maker.
Exactly. You have to research the physical enablers.
Oh, life.
Think about utilities, particularly those with strong, regulated monopolies. They're the gatekeepers for power delivery. Nuclear energy is also critical. It can provide the massive, stable baseload power that AI training demands. 247.
And the material inputs are huge. Copper is absolutely essential. Every new data center, every mile of transmission line.
Huge quantities of copper wiring. So copper mining and processing suddenly become infrastructure plays, not just commodity plays.
And then there's the overlooked aspect, cooling systems.
Yes, all that power generates intense heat. Companies specializing in advanced liquid and vapor cooling systems are providing a critical bottleneck solution. This focus on the physical layer is a fantastic hedge.
A hedge against what?
Against the possibility that the initial AI software valuations, those really high-risk, high-growth bets, might eventually falter. The power grid has to expand regardless of which specific large language model wins in the end.
That connection between the financial cost of capital and the physical cost of power is so powerful.
Right.
But that infrastructure is being built in a world that is, well, it's fundamentally unstable.
Which brings us right to our third major force, the permacrisis.
The permacrisis. It's a heavy word. What are we really talking about here?
The permacrisis is the recognition that we are in a state of permanent instability. It's not just one crisis. It's a cycle of geopolitical flare-ups, persistent trade tariffs, regional wars, supply chain shocks.
You can't predict which one happens next.
But you can confidently predict that a crisis will happen.
And this requires a fundamental psychological shift for the investor. The days of trying to time the market or predict the next crash are even more futile now. The goal is to build an anti-fragile portfolio. Let's define that term.
Right. So anti-fragile, a concept popularized by Nassim Taleb, means more than just being robust. It means structuring your assets so that you actually benefit from disorder, stress, and volatility.
So it's not just about surviving.
Exactly. A traditional portfolio is fragile. It breaks under stress. A robust portfolio survives stress. An anti-fragile one actually gets stronger.
Okay, so how does that translate into concrete investment strategies?
We've identified 3 key defense strategies for this environment. Strategy 1 is the allocation to hard assets.
Old commodities.
Gold, a diversified basket of industrial commodities. Oil, agricultural futures. They have historically maintained a very low correlation to both stocks and bonds during geopolitical shocks. They act as essential crisis insurance.
Okay, they stabilize things. What about strategy two? This one's about supply chains.
Strategy 2 is about operational redundancy.
Hmm.
For the last 20 years, the business mantra was relentless efficiency. Find the single cheapest supplier wherever they are in the world.
A model that is a fatal single point of failure in a permacrisis.
Absolutely. If the Suez Canal closes or a regional conflict disrupts chip manufacturing, your business model collapses instantly.
I remember the huge chip shortage during the pandemic that crippled entire industries. A perfect example.
Precisely. Now, businesses are prioritizing resilience. This means having multiple suppliers, even if they're a bit more expensive or located closer to home. Investors should look for companies that demonstrate this commitment.
Friend-shoring or onshoring, right?
Exactly. It's a long-term trend that supports domestic infrastructure and logistics, even if it costs a bit more in the short term.
And strategy three is how we structure our growth investments in this turbulent landscape. The barbell strategy. I love this concept. Let's walk through it.
The barbell approach is designed to eliminate the anxiety of prediction. It posits that you should put the vast majority of your capital, say 80%, into extremely safe, stable instruments.
The high-yielding treasuries we just talked about?
Yes, those treasuries, money market funds, broadly diversified low-cost index funds. This 80% is the anchor. It's designed purely for capital preservation and reliable, steady growth.
And then the fun part. You take the remaining 20%
And you use it for the high-risk, high-reward bets.
all the way out on the risk curve.
Exactly. That 20% goes into extremely volatile, potentially high-return investments. This could be early-stage venture capital, cryptocurrencies, or those specific high-risk AI software picks. The key is that the potential loss of that 20% does not endanger your core wealth.
The brilliance is that you avoid the mushy middle. You avoid the average risk, average return investments that often get crushed when instability strikes. You're maximizing safety and maximizing asymmetrical upside at the same time.
It's a structure built for times of uncertainty. It provides the framework. So now let's wrap this up with the immediate action plan, the listener checklist you can run through today.
Let's start with the most urgent issue from the return of cost. Audit your debt.
Correct. Since rates are structurally higher, variable rate debt is now a guaranteed wealth destroyer.
So credit card balances, personal loans.
Home equity lines of credit,
Yeah.
HELOCs at rates of 10% or more, that has to be addressed immediately. That guaranteed interest expense is far outpacing any safe investment return you can find. It's step one. Kill the expensive debt.
Right. And step two is performing the physical pivot in your allocations.
Yeah, look at your existing portfolio. Do you have sufficient exposure to those real assets we discussed?
Not just commodities, but the infrastructure plays. Energy companies, utilities, copper exposure.
It hedges against the AI hype cycle and protects you if global supply shocks reignite inflation.
And the simplest, most immediate check you can do today relates to your cash. We said cash isn't trash.
But only if it's working for you.
Mhm.
If your emergency fund or savings are sitting in a traditional checking account earning 0.01%,
Which is common at the big banks.
you are losing value every single day. You have to transfer that cash into a high-yield savings account or a money market fund. Make sure it's earning at least 4%. It's the easiest fix to make immediately.
So here is the final challenge. The assessment question you should ask yourself when you look at your investment statement this week. It wraps up all three themes. I want you to look at your current portfolio and ask, how much of my money relies entirely on the world remaining peaceful, calm, and predictable?
If the honest answer to that question is 100%, then you are still investing in the easy mode of the last decade.
And you need to rebalance.
You need to rebalance toward an anti-fragile structure that is prepared for higher rates, power scarcity, and permanent geopolitical instability.
Which brings us to a final, provocative thought that really ties all of this together. The future of AI success might not be defined by which company has the most sophisticated algorithm.
But by which company has the most reliable, cheapest source of power.
That's it.
That's right. The rising cost and scarcity of physical infrastructure, the copper, the grid, the cooling, and the geopolitical risks of securing that supply chain will define which AI companies survive and scale in the long run. The fundamentals are shifting back to physical reality.
Away from purely digital promise. It truly is a new era for investing, and understanding this shift is essential for prospering.
It really is.
Thank you for joining us for this deep dive into rebuilding your portfolio.
And if you want to keep gaining knowledge quickly and thoroughly, make sure you try out our latest episodes where we tackle other complex topics shaping our world today. We'll catch you next time.